What do you make of A, Schumer and McConnell talking, and some of these votes that are scheduled in the Senate tomorrow?
Well, yeah, I think more talking is better than less talking for sure. I don't necessarily think that we'll see a breakthrough on the government shutdown tomorrow, however. I think that by and large, these will be more symbolic votes. There'll be 2 votes that are scheduled tomorrow afternoon. They'll probably fail to get the 60 votes required to pass. But you sort of suss out where your caucus is, kind of the votes in the Republican Party, the votes in the Democratic Party. But I don't think we'll see an end to the shutdown tomorrow.
Hassett today, making some news, sort of echoing what others have suggested, and that is that this lasts long enough, you do get a goose egg on Q1 GDP.
Yeah, absolutely. I mean, we're sort of describing it as a pothole. But this pothole gets deeper and deeper the longer the government is shut down, right? This is unprecedented. We're on the 33rd day, as you said, and the longest government shutdown before was only 21 days. We're expecting, like the NEC and the CEA, about a point, about 10% shaved off every week the government is shut down. So you can actually see about 0.5% being shaved off in first quarter GDP. And that's not to mention all of the other ancillary economic activity that's lost as well.
And yet S&P has never performed better in a shutdown.
So I think we have to remember the fact that it's not a recurring thing. So what we are talking about is the trend growth rate. And the trend growth rate, despite a shutdown-related impact, is still pretty much together. And we are talking about, close to 2%, probably slightly north of 2%. The economy had enough momentum coming in. So despite the shutdown, I think it'll be okay, as long as we reach a settlement of some sort. We can't afford own goals. I think both trade and shutdown are own goals for the markets.
What about the debate about what you get back afterwards? Larry Kudlow suggests there is a snapback. Jim's point this morning with us was that maybe some of these employees get extended on credit, and that's hard to work off, even once your paycheck resumes.
Well, I think you probably don't get all of it back, but I think you get a substantial amount of it back. Having said that, I think the thing that we have to focus on for 2019 is the fact that despite the fact that the economy is going to be softer than it was in 2018, we will have significantly better policy. And that policy gets the markets higher rather than the strength of the economy or earnings growing at a significantly higher pace.
Hey guys, it's Sarah from Davos. I just had a question for Libby, because Libby, CEOs here are talking about these big risk factors, the shutdown, the Brexit, the trade war. They're all solvable and they're all political. And if politicians can solve them, the picture for 2019 and beyond is going to look a lot clearer. But one of the issues is we're just not getting the market pressure like we got toward the end of 2018 that would push these politicians to any sort of resolution. Without that, can they solve it?
Yeah, I mean, I think that's obviously a great question and is on the minds of many of our clients as well. Our view has been that political risk, policy risk was going to be a big headwind for the economy and for markets, both in 2018, and we don't see that changing as much in 2019 either. Maybe the China-U.S. relations are getting incrementally better. Maybe the president may be more inclined to make a political deal than really hang in there in terms of escalating trade tensions with China. However, there are other risks that are kind of in the forefront. NAFTA withdrawal risk continues to be something that we're monitoring. Auto tariffs, the fading fiscal stimulus, and really we don't really see any big kind of fiscal impulse on the horizon. So, we continue to think that there is more kind of political risk than opportunity here, and I think the government shutdown is the latest example of that.
So, Libby, I'm just curious. I mean, you mentioned your clients. Are they calling and really asking? Do they seem engaged on trying to figure out the impact of the shutdown?
Yeah, I mean, it's interesting. Our CIO, Dan Iveson, is over in Asia, and he'll say that this is one of the leading questions that our Asian clients are asking. I'm going to Australia next week. I mean, our foreign clients are very concerned about what's going on in the political environment. I think from an observer's, from an outsider's perspective, it seems like we're more of a country in crisis than we actually are from an internal perspective. So we're doing a lot of education, a lot of clarification, but absolutely, especially our clients externally or outside the United States are concerned about this.
Well, I think while the impulse is not to get to a settlement too quickly, as the economy slows down, both here and is happening in China, for example, the pressure to reach to some sort of a settlement increases meaningfully as the year goes on. So from our perspective, the policy is going to be supportive at the place where it matters the most, which is the central banks. The Fed has backed off. The ECB is probably going to be taking easing measures such as an LTRO, and China will probably throw in the kitchen sink to support its growth. I think that combination probably gets us higher from a S&P perspective.
So you're not worried about financial conditions loosening again and the Fed being back in play?
Well, so I think that risk always exists. So in that context, 1%, 2% drawdown is probably a good thing. If the market rallies 15, 20%, then the Fed gets a free pass. Then they're back in their game that they were in 2018. I don't think we get there because there are enough uncertainties with respect to growth and other issues. So it's a probably 5 to 10% type S&P target for the full year from our perspective.